We just need a whole.
So. Well, I didn't go to Staples.
Curious why some people do what you do, some people do.
Oh, why I stapled them together
Why you do it
in
that
order?
way, so they can find the session slides.
No, it's because it's about as thick as I can have it before I can no longer staple them together. That is. Exactly. Yeah, there's not some grand organization.
First, a reminder in case you haven't started working on your valuation, it's time to get started. So, spring break is coming. You haven't even picked a company, I know. One of these days, you know what? Once you get towards April and you're graduating on May 9th, 10th, things are going to get really difficult to do. So get it done before that moment hits, right? So premature graduation is the last thing you want to be fighting. And so get that, please, that feedback thing, because that's most of the project, actually. If you can get that DCF to me on April 4th, you got the bulk of the project done. There's a pricing section, but that's really kind of topping off section. So today is one of my favorite sessions in this class, and you're going to see quickly why that is. Because it's about connecting stories to numbers. It's the title of one of my books. It's actually, I'll talk about, at the start of the class, I talked about how I came to that recognition that you can't value companies without telling a story. And you know how difficult it is to get that idea across, especially among numbers-driven people? Sometimes, I remember right after I wrote the book, I was giving this talk at a bankers conference. And the banker said, this story thing, it's all fuzzy. You're making biased judgments. I don't work with stories. I just work with numbers. So I asked him to give him one of his DCF valuations. And I took his DCF valuation and read back the story I saw in the valuation. So I'm going to make you play that game. Let's suppose I'm a numbers guy. I show you a discounted cash flow valuation, and I'm going to go give you the inputs that I used. And from the inputs, I want you to reverse engineer the story. So I've estimated a compounded annual growth rate of 50% a year for the next 10 years. Right? I'm estimating an operating margin of 20%. And you compare to the industry average, it's twice as high as the industry average. The company is reinvesting very little. It's a high sales to capital ratio, reinvesting very little. And its cost of capital is much lower than that of the average company. You have the histogram there. So all you see are the numbers. I want you to reverse engineer from these numbers what the underlying story is. First, can you guess the company size? Based on the numbers, is this company that this guy is valuing or this person's valuing small or large?
It's small.
Better be small, right? Because he's saying $1 trillion company and doing this, he's going off into fairy tale land. Probably small. And what's the clue that makes it small?
The 50% annual growth rate.
50% compounded over 10 years is making your company 100 times bigger than it is today in terms of revenues. That's a terrifying. If you have $1 million in revenues, you can pull it off, but $1 billion, that's going to be much more difficult. Is there some implicit story about the total market? Is it, you think, stable or growing? If it's stable, how does the growth come? You come from fighting for market share, right? Implicit in the story is there's not much fighting because you're increasing and your margins are going up. So whether the analyst tells you or not, the market better be growing. If it's a stable market, we have a problem with the story. Are you learning something about the competitive advantages this company has? What are the numbers that kind of you're strong or weak based on those numbers? Leon, you want to try?
That's pretty good.
And the reinvestment rate is not going to tell because that's a choice by the company. So what are the things you look at to see if you have a strong competitive advantage? You're going to look at the margin, twice the size. There's something that's driving it, either a brand name or something that's. And finally, is there anything you can look at in these numbers that'll tell you something about the capital intensity of the business? What do you think? Low capital intensity, high capital intensity? And you sounded like you were guessing, so I'm going to push you on this.
Okay.
What part of that story makes, you're right, it is low, but what part of the story gives that away?
Low investment.
Low reinvestment, right? Capital intensive businesses, to grow, you need to reinvest more. And can you guess something about the nature of the product? Is it discretionary, non-discretionary? Where, no. Again, you have 50-50 shot. I'll help you out.
Yeah.
Discretionary, non-discretionary.
Discretion.
Try again. Margaret, you want to help it out? What part of the inputs will tell you whether it's discretionary or non-discretionary?
I guess we're non-discretionary because the CAGR goes 50% retake.
Don't look at the number that's going to give you away is no margin is brand name. The cost of capital. Remember we talked about betas? What keeps the beta of a company low? You provide non-discretionary product. You're a grocery store, you're going to have a lower beta than if you're Whole Foods. The cost of capital is low. So what he's telling is a story about a small company in a growing total market with strong competitive advantages, a very non-discretionary product, and low capital intensity. So you read the story back and say, do you buy the story? And if the banker says, look, that is the story I was trying to tell, we're settled. But if you say, that's not the story I want, then you change the numbers. So one thing we're going to talk about today is how every time you use a number for a company, whether you like it or not, you're telling a story for the company. And you got to stop and ask yourself, do I believe my own story before you show it to other people? Each of you has a company. As you sit down to value, you'll have a spreadsheet, but you're also simultaneously developing a story. I want you to make that story explicit. So let's say you've told that story. Who are you valuing, Leon? Reddit, that's right. Yeah. So what's the story you would tell for this company?
They're not profitable now.
Before you do that, what business are they in? How do they make money? Ads. It's an online advertising company. The more people that get on Reddit, the more money you make, okay? So you need people on the platform, and not just more people, but you need them to stay on the platform. That's what Facebook versus Twitter showed us, right? Facebook is a more valuable online advertising platform because you come and you hang out. The average person on Facebook spends 57 minutes a day. That includes Facebook, Instagram, WhatsApp. So the story here is not only about how many people go on Reddit, how long do they stay? Do you spend a lot of time on Reddit? You can admit to it if you can. It's not a bad thing. But the question is, that draws a subset of people who essentially are drawn to those Reddit discussion boards that basically there might be topics they're interested in. So is it, what's the total market? Is a total advertising market, right? 10 years ago, online advertising was a small part of this market, and it was growing, not because the advertising market overall can't grow very much. Why not? Where does the money come from? It comes from companies spending on advertising. It's a cost item. So if advertising grows 20% a year, everybody's going to go bankrupt along the way, right? So the total advertising market is a pretty mature market. Online advertising was growing because it was a small part of the market and it was essentially disrupting newspaper advertising. But those days are done, right? Today, online advertising is about 2/3 of the overall advertising market. and characterize the market more. It's a market that's 2/3 with two giants, which are Facebook and Google, right? The question is, where does Reddit fit in there? I mean, is it going to go after Facebook? Do you think it'll get as big as Facebook? No, it's not that. It's a niche business, but there's enough money there. And essentially saying, what is that niche going to be? How big is it going to be? That's your story. You're saying that's the story that's going to drive your revenue growth. It's a high margin business. That's good news, right? Because it costs almost nothing to produce. You have to maintain the platform, but those are mostly fixed costs. As you grow, your margins are going to improve. So you'll see margins improving because of economies of scale. Capital intensity is pretty low, right? You got to invest in platforms unless AI changes the game somehow, in which case you have to think about what that'll do. And finally, is it discretionary, non-discretionary? I'm going to ask Leon how addicted he is to Reddit, right? I mean, that's really the question. I mean, let's face it, social media, and Jonathan Haidt has an entire book on this and how addictive social media platforms are. Maybe there's an argument that social media platforms have less risk than the newspapers of yesteryear, making their revenues less unstable. There's a story here, right? So Leon's going to work on the story, convert to numbers, show me a valuation, and that valuation will be as much a reflection of the story as it is of the inputs that went in. Jessica, who are you valuing? Don't worry, I'm sorry, my mouth was full, but Palantir, oh my God. I will let you think about the story, right? Because there are two branches to the story. There's the defense part of the story, there's the commercial part. It's perhaps one of the toughest companies to tell a story about, because I've actually, even though I don't go on Reddit very often, I sometimes have visited it. I have never used a Palantir product. Jessica, have you? Okay. It's a bit more business to business. You encounter it more on a business to business basis. Already you can see telling a story about a B2B company is inherently more difficult than a B2C company. Okay? Doesn't mean it's impossible. It's a different story. So each of you, I want you to already start thinking about the story. So let's say you come up with a story for your company. You're saying, I'm done. Not quite. Let's think about some of the things that might change that story. Okay? And you tell me whether any of these could change the story. Could a new earnings report from your company change your story? Yeah. If it's Coca-Cola, it's unlikely, right? What are you going to learn in a new earnings report? But if it's Palantir, the next earnings report could be hugely consequential. Because what could it contain? It could contain the announcement that the CIA has decided to quadruple its investment in Palantir and spend more money on AI. That's going to change the story. And already you can see for young companies, an earnings report, it's not the numbers, it's what it does to your story. So an earnings report, could a macroeconomic change like inflation and interest rates? Yeah. At the margin, at least, right? If you're Walmart, today you saw the inflation numbers came out, they came in a little less than expected. That's good news if you're a company where inflation is the key driver of value. Less so for Palantir. Right? It's a side story. Could a regulatory change affect your story? At least for a subset of your companies, right? If it's a utility, if it's a telecom company, changing regulations can make you more. In fact, you could argue that what happened to Google last week was a regulatory shock. Right? You know what I'm talking about. Google was targeted by the Justice Department last year, and the targeting was they were going to be forced to sell off their browser, Google Chrome, and Androids. And then the election happened, and everybody assumed the problem had gone away because it was Lina Khan who was pushing for it. And last week, the Justice Department announced that it hadn't gone away, that they were going to continue with it. What did Google's stock price drop? It dropped about 8-9%. Did it drop by too much? Well, the only way to play it out is to look at how this story plays out. Because this is not the end of the story. This is the start of a legal battle. It'll cost money, it'll cost resources. And there is a possibility, I think it's low, that they will be forced to spin off or sell off Google Chrome and Android. Could an earnings report from another company affect the story for your company? Julian, give me an example. Right. Amazon announces they're entering almost instantaneously. You know what happened to Chegg when AI took off? Chegg is a homework company, right? So basically, they were growing fast, then AI comes along, and it turns out that ChatGPT can answer the question, explain the hypotenuse theorem to me as well as a person. Chegg's value pretty much plummeted towards zero. All of the above. I mean, people think of it as, find this unsettling. I find it fun. It's interesting. This is why valuation is interesting. You're never quite done. This notion that you've told the right story and it's timeless. You're not a novelist. You're not written, To Kill a Mockingbird, right? This is a story that's going to change because the world is changing around you. And welcome to the last 2 weeks. Right? Think of all those companies that 2 weeks ago you had a story that now you got to revisit that story with. Now I'm writing a piece on Trump, tariff, and taxes that has very little to say about Trump or tariff or taxes, but to talk about how we got to where we are. Because these are things that shake your stories, change your stories, and affect your value. One final point, right? And I think we've kind of answered this. Every valuation is a balance between stories and numbers. But remember the notion of a corporate life cycle that I took you through, young companies, growing companies, mature companies, declining companies? I wanted to think about that balance between stories and numbers as you go through the life cycle. So somebody during the lunch break came in and they're valuing a fintech company, which kind of means nothing, right? What kind of fintech? This is the buy now, pay later kind of fintech. You know what that is? You go buy a couch, you don't have money to buy a couch, they will finance the buying of the couch. It's a young fintech company, and the group is trying to value. When you think about valuing it, there's no past data to go on. There's really no basis for the projected numbers. It's all about story. And what's the story going to depend on? How big is that market? What's that market look like? Who's buying now? Because you're not talking about buying a house and paying later. You're talking about buying a couch and paying later. You're talking about people who are essentially at the very edge of economic. So they're living paycheck to paycheck. So what kind of default risk will there be in there? Significant. So the question you're asking is this a company that charges a high enough interest rate to cover their default risk? And will there be shocks to this company? In fact, what kind of macro shock does this company have to worry about? A recession, right? Because then you're not just going to get 3 people defaulting, and banks have always faced this, right? So how have banks kind of buffered themselves against this? Even if they didn't do it, the regulatory guys come in and say you need regulatory capital. So the question asked was, do they have a buffer? Because fintech companies many of them are regulatory arbitrage. What does that mean? They're acting like banks, they're lending to very risky people, they're charging high interest rates, they're going to look great for the moment until that shock comes, and then they're going to go under. And the scariest thing is they basically will walk away. VCs would have made money coming into low price and a high price. It's, I think, an opening in the fintech space that is being exploited that you need to think through. Young companies, it's mostly stories. As companies age, the numbers kind of, the way I like to describe this is when you're valuing a young company, it's like you've been called in to finish a book that an author has started. Not Daniel Steele, because AI can write that book, but somebody who's a little more unpredictable, right? So you're chapter 1, the author's died, you now have 33 more chapters, you can tell a very, very different story. In contrast with a mature company, you're coming in chapter 18 of a 34 chapter book. The characters have already been set. You can't create skewed stories. And if you're a declining company, you're in chapter 33 of the 34 chapter book. Don't create new characters who wander on. So when you think about valuation, you can already see as you move through the life cycle, the tilt will be towards numbers. And this is why pure number crunchers got away with it for so long, because for much of the last century and into this one, the typical company valued in public markets was a mostly mature company. You're valuing Coca-Cola and Kraft Heinz, you can be a pure Excel ninja and get away with it because who cares what the story is? So those are all things I want to talk about. We'll navigate those those waters as we go through, but let me first finish up something, the last piece of the loose end puzzle. We talked about the fact that more and more companies pay their employees with equity. That equity can take the form of options, it can take the form of restricted stock. And I already told you up front, restricted stock is the easier problem to deal with because there are two issues you got to deal with when you have stock-based compensation. One is, how do you deal with the deadweight cost of stock-based compensation that's been used in the past? You know what I mean by that? You've been giving options last year, 2 years ago, 3 years ago, 4 years ago. How do you deal with that deadweight cost? The second is, to the extent that this company is going to continue to use stock-based compensation, how do you factor that in to your analysis? So let's start with the easier problem, restricted stock. What's restricted stock? What part, when we say restricted stock, what's the restriction on the stock? So if you get restricted stock,
The time when you receive it, so it vests.
that's vesting, right? Vesting is one problem. Restricted,
Sell it for.
you can't sell it. So I think you were going there as well. So there is a restriction on trading. So already you can see if I give you publicly traded shares, when I say you can't trade them for the next 2 years, there will be a discount you will demand because you say, look, I need liquidity. But restricted stock, the shares themselves are regular shares. So when you have restricted shares, the solution is simple. Don't play games, add it to your regular shares. Having said that though, I find that most data services are incredibly sloppy about what they do with restricted stock. Yahoo, for instance, Finance, when they report the number of shares for a company, don't include restricted stock, which might not be a big deal if you're looking at a big company like Apple, but you're looking at a company that's just going public. I remember valuing Peloton at the time of their IPO. There were like 7 classes of restricted stock because they'd been paying employees with restricted stock. Those shares need to be counted in, which requires that you go through the footnotes. It will not show up in the balance sheet, will not show up in the data services. You got to kick through the footnotes. I think one reason companies have shifted to restricted stock is options for a long time gave companies a way of giving away stuff and not having to reflect it. The accounting rules changed in 2007. This might be pure coincidence, but pre-2007, 90% of the compensation, stock-based compensation at US companies took the form of options. Today, 90% is the form of restricted stock. Amazon hasn't issued options forever. They have a few left over from a decade ago. Companies have moved to restricted stock. Thank God for that. Easier to deal with in valuation. Bring it in. If you expect this company to continue to issue restricted stock in the future, what will that mean? Well, that's a drain on your income. And don't give me that non-cash expense nonsense. Restricted stock and options are not non-cash expenses. They're in-kind expenses. Essentially, you've taken a slice of my equity, you've given it away. That's a piece that's worth something. All you did was skip a step, right? If you'd taken the restricted stock, issued it to the market, taken the cash and paid me, I'd have shown it as an expense. I can't let you use a barter system to evade cash flows. So past restricted stock count in the share count. Future restricted stock show as an expense, lowering margins, earnings, and cash flows in the future. Seems like a double counting, but you're counting for 2 different things. Do you see why? The past restricted stock, the share count reflects it. Future restricted stock, you basically reduce your earnings, cash flows, and come up with a lower value. But let's talk about options. We all know how options work, right? Typically, employee options are a little different from the options you and I trade on the Chicago Board of Options. Jessica? They don't have to set aside a portion of the balance sheet, right? Because as a restricted shareholder, you're like any other shareholder. There's nothing, with options, you have to come up with shares to cover the option exercises. I give you restricted stock, you actually have shares in my company. The only thing for the next 2 years, you can't trade the shares, but you're like any other shareholder in the company, right? So it goes into, it kind of disappears into that equity number that you see on a balance sheet, because you're now an equity investor in the company like everybody else. With options though, yes, go ahead.
So when we reduce the value of the company because of the.
Let's be explicit. The way we reduce it is by giving them less earnings in the future, right? They give them lower margins, lower cash flows, lower value. Okay, keep going.
So when we calculate value per share, we will not.
So you got the
number of shares.
But that number of shares will reflect past restricted stock issues, but you will not count in expected future restricted stock issues. Why not?
Because we already accounted.
Double counted, right? So don't mess with this future share count change. It's a nightmare because you're going to be in the circular logic problem, right? Because to figure out how many shares you're going to have to issue in the future, you got to figure out what the price will be in the future, right? Companies don't give share count, they give value. So if my share is worth $1,000 per share, NVIDIA at $300 per share to give away fewer restricted shares than at $30 per share. So that's why you want to avoid all future share count issues and try to affect it through the cash flows. You're going to see me do the same thing with options. Let's look at options, right? So you're a shareholder in a company. Let's say we're all shareholders in the company. The company grants options. Typically, when companies grant options to employees, they're long-term. 10 years is a typical term for an option. That already makes it a little unusual, long-term options. Typically, when companies grant options, they give them at the money. You know what I mean by at the money? The stock price is 10. You're saying that's worthless. No, you've got 10 years to play with this game, right? And at the money option is definitely not worthless. And this is where accountants made their fatal mistake. Before 2007, if you as a company, granted options, if they were at the money, accountants said they were worth nothing. One of the most nonsensical perspectives, because it led to some really, really bad behavior, right? If you're a company and I tell you options at the money are worth nothing, 1,000 times nothing is worth nothing, million times nothing is worth nothing, 10 million times nothing is worth nothing. So what do? You give away large slices. It doesn't affect your earnings. It doesn't show up in your share count. And your accountant says, don't worry. 3 years later, the stock is up 50%. And all of a sudden, you wake up to the fact that you've given away 20% of the company. So when you look at options, the reason they become an issue is even though they're granted at the money, if the stock price goes up, employees can now buy the shares effectively at a discount. And you and I will bear that discount. Again, I can understand why companies give options, but don't lie to my face and tell me they're worth nothing because they are worth something. You see, what if stock prices go down? Stock prices go down, what do employees do? They don't exercise. So one-sided game, right? You get the downside, you get no upside. So options always have value, even if they're at or below the stock price. So with that in place, I'm going to set up a very simple example to illustrate the 3 ways in which I see analysts deal with options. One is extraordinarily lazy, but unfortunately, a lot of analysts take this back. The second looks okay because it looks like but there are implicit assumptions here that should worry you. And the third is the one that I'm going to push you towards because I think it's the right way to deal with options. So I'm going to present you with a company. Company has 100 million in free cash flows, growing 3% a year in perpetuity with an 8% cost of capital. If you think about those numbers, basically you put in 100 million is expected free cash flow divided by 0.08 minus 0.03. The value of the firm is 2 billion. It's got $1 billion in debt. You subtract that out, you get $1 billion in equity. And let's say that in this company, there are 100 million shares outstanding. The value per share is $10. It's a pretty trivial example, right? Let's say you value the company shares at $10, and this company now grants 10 million options to its CEO with a strike price of $10. So what's the accountant going to tell you? Don't worry, they're at the money. But I want to ask you a question about what your value per share would. Remember, it was $10 before this grant, and I'll give you the 3 choices. First is you listen to the accountants and say they're at the money, so it doesn't affect me, right? The second is that the value should decrease by roughly 10% because you have 10% more shares now than you did before. So it's a very conservative way of saying the options have been granted. I'm going to count the shares. The third is it'll decrease, but not by 10%, that there's something that buffers that impact. Because at 10%, you just count the number of shares. You're not counting in the exercise price and everything coming in. So here are the 3 ways in which people deal with options. The first is they take the $1 billion in value of equity that we got before, but instead of dividing by the 100 million shares outstanding, they divide by 110 million. It's called fully diluted, basically use the fully diluted count. You come up with the value of $9.09, but I can almost guarantee you've undervalued the company. Why is that? What are they missing with when they do the 10 million additional shares? First, they're assuming the options will be exercised, right? What else are they're missing? When those options get exercised, what do the employees have to do? They've got to pay $10, right? That's a miss. How do you miss that? You've assumed their exercise. Okay, I'll go along with you. But where did the $10 per share go? So the second approach fixes that. It's an easy fix. What do? You take the $10 per share that you're getting from the option exercise times 10 million. You come up with 100 million as the additional cash. So you play it out. It's going to get exercised right away. That's 100 million in cash. That increases my numerator. I divide by 110, and the value per share I get seems to agree with what the accountants told me, right? This is called the treasury stock approach. Analysts all over the world use it. But when you use it, what are you implicitly assuming? There is no time value on the option. So the $9.09, you're undervaluing the company. The $10, you're overvaluing the company. There must be a Goldilocks solution. And here's the Goldilocks solution. You take the 10 million options, you value them as options. So here's the process. You start by doing what you traditionally do. Don't even think about options while you're doing the valuation of your company. Don't let it distract you. Value the firm. Subtract our debt. So far, add cash, subtract debt, you come up with the value of equity. But before you divide by the number of shares, I want you to pause and value those 10 million options as options. You say, what the heck does that even mean? What do option pricing models do? Forget about the specifics of the model. When you use Black-Scholes or binomial to value an option, what exactly does that value reflect? What do you want to try? You come up with the value, right? You plug these numbers, S, N, D1, KE minus RT. You say, what's this foreign language? But at the end, there's a number at the end. But if I ask you to intuitively describe what that number is, what is it trying to measure? First, there's a normal distribution, right? What is that doing? It's capturing the fact that stock prices can go up or down. It's capturing the fact that if there's more movement in there, there is an expected likelihood that your option will get exercised. It's trying to compute an expected value for your options across all scenarios. That's basically what the option pricing model is. If we strip it of all its mistakes. It's a way of capturing the expected value of these options given how uncertain your stock is. In fact, to see why that is so, if you make the normal distribution into have a standard deviation of 0, in fact, it's certain, what happens to the value of your option? It goes to 0. So in that special case where there's no uncertainty, the value of the option goes away. So as I increase the uncertainty, the expected value of the option goes up. We've had option pricing models now for 50 years. But when employee options came along, they were troublesome. They were tough to fit into option pricing models. And here's why. The Black-Scholes model, the original option pricing model, was designed to value options on the Chicago Board of Options. If you get a chance, check out that page, the Chicago Board of Options page. You're not going to get 10-year options. You're getting 3-month options. So it was designed to value short-term options. That's the first problem. The second is, if you exercise an option on the Chicago Board of Options, it's a side game between two players. It's got nothing to do with the company. When you exercise a management option, the share count can actually change. Do you see why? Because the company issues shares, the share count can change. So here there's actually an effect on the price, but the act of exercising an option will change the price per share. This is a circularity here because you go to exercise the option thinking it's in the money. The very act of announcing that you're exercising can lower the stock price. The third is the Black-Scholes model was designed to value what were called European options. It's a very unfortunate choice of phrase because it suggests it's got something to do with geography. It doesn't, right? Constantine, what's a European option? You can pass it to France. He knows. He's ready to give you the answer.
The European one, I know that there are two types of option.
European and American. I said it's
One of them is exercisable until the maturity date, and the other is the other way around. So exercised on after the maturity.
None of them can be exercised after. One can be exercised only on the maturity
Yeah.
date. That's a European option. The other can be exercised any time. So if I gave you a choice between a European and American option, every other character is the same. Which one should be valued a little more highly? The American, because you get all of the rights of the European plus. Black-Scholes was designed to value European options. We use it all the time to value American options. You know why we get away with it? Talked about the Chicago Board of Options. 98% of the options, maybe 96% of the options, the Chicago Board of Options get exercised in the last minute of the last day. And there's a reason why, right? Let's say you buy a call option on Tesla because you think it's coming back. Stock price right now is 220, it's down 50%. This is it, this is the bottom. Let's say in a week, the stock goes to 300. You guessed right, right? You bought a call option. There are two things you can do. One is exercise and collect the difference between 300 and the exercise price. What's the other thing you can do? You can sell the option. And you see why selling is going to beat exercising almost every single time, because when you sell, you get whatever you got from exercise plus a time premium. With regular listed options, because they're traded, you almost never get early exercise. But let's say you're an employee at NVIDIA and you got options in 2018. You know the adjusted stock price was then, because there's a 10-for-1 stock split. It was $2.80 per share. So you have 1 million options you got at $2.80 per share. What are those? What's the stock price now, even after the drop in the last couple of weeks? $110 per share. You're a rich person, at least on paper, right? You're worth $110 million. You have 6 years left in the option. Do you see now, in this case, why you might be torn between exercising early and waiting? You can't sell those options. Management options are not sellable. They're not liquid. So you could say, I'm going to fall for the time premium, but what could happen in the next 6 years? NVIDIA could go back to 30 or 40. So with management options, you are going to get early exercise. In fact, it's estimated that management options get exercised about halfway, or employee options get exercised about halfway to their maturity date, because people just get scared, and I can't blame them. This is completely rational. You want to cash out saying, if I wait, it might wipe out my 100 million, might go back to 2 million or zero. So already you can see option pricing models have all these mechanical challenges. And for a long time, that's the excuse accountants use for, we can't value options because option pricing models don't work with employee options. That's not true, though. You can adapt option pricing models to value it by factoring in a dilution effect. I'll show you how I do it. And by reducing the maturity if you need to, right? Instead of a 10-year maturity, use a 5-year maturity. And that's basically what I did. I took that 10 million share, 10 million options granted. The strike price is $10. Technically, it looks like it's at the money. But the minute you exercise, I can compute the dilution effect. It's actually fairly straightforward. The stock will drop to $9.58. So basically, I'm going to use that diluted stock price of $9.58. It's a slightly out of the money option. I'm going to leave the maturity at 10 years. I could have brought it down to 5 if I wanted. I valued the option at $5.42 per option. What does that capture? It captures the expected value of this at the money option if you let it ride for the next 10 years. They gave away 10 million options. That's worth 54.2 million. So I take the $1 billion in equity, I subtract out the 54.2 million, saying, I've given it away. That's an equity slice I've given away. I come up with 945.8 million as the remaining equity, and that I divide by the 100 million shares. Don't divide by 110 because that'll be double counted. But the way to deal with options is to value them as options, take them out of your equity, because you created a second equity claim on your company. So when you look at employee options, much as accountants say it can't be done, since 2007, this is what companies have had to do. So option pricing models have actually become pretty good at value. So now when you look at a Cisco and you look at their cost of goods sold, it does include employee options already. The right thing to do, right? But to show you no good deed ever goes unpunished, What do companies and analysts repeatedly do on every company after they get the earnings from accountants? They add back the stock-based compensation, creating concoctions like adjusted EBITDA, adjusted for what? Add it all with the stock-based. What is wrong with you guys? Why would you add it back? It's not as if it's like depreciation. It's a nice cash flow. This is an actual expense. You gave away pieces of my equity. There's zero excuse for doing what companies and analysts are doing. But you know why they do it? Because no, I would love to say it's taxes. That's actually rational. It doesn't change your taxes 1 cent. Because your taxes are set by the tax guy. The fact that you added it back doesn't make the tax go away. It's because so many analysts, how do they put a price on a company? What's every analyst's favorite multiple now? It used to be PE ratio 40 years ago. Today it's EV to EBITDA. It's every banker's magic, EV to EBITDA, EBITDA multiple. So what the heck are you doing? EBITDA multiple. As if, and they're arguing it's a cash flow. It's a very rough measure of cash. It's a half-assed cash flow because you added back the depreciation. You want to do cash flows. What about CapEx? No, I'm just stopping after da. So if I know you're a lazy analyst who prices companies at 8 times EBITDA, and I'm a company, you've sent an invitation to me, right? You want me to pump up EBITDA, I'll find ways to do it. And that's exactly what the adjusted. If you don't believe, take one of these IPOs, there'll be an adjust. It's for laughs alone, looking at what they add back. Airbnb came up with this version of adjusted EBITDA that WeWork came up with a version of adjusted EBITDA where they basically took the expenses associated with running the building, which is an operating expense, and add back and called it some community expense. I really, what? It's a community adjusted EBITDA. And said, now we're talking, right? What the heck does that even mean? It'd be like Uber saying, I'm going to add back the 80% that we pay for drivers and call it a driver adjusted EBITDA. Right? But we reap what we sow. If we take 8 times EBITDA and we're not careful, that's exactly the game we're going to play. So when you look at options, don't play that game. And if you have options in the future, they become part of expenses. They reduce your earnings. Usually what happens as companies scale up is option expenses drop off as a percent of revenues. You know why? Because eventually they get replaced with cash revenues, cash expenses. You start to pay your employees with cash. I don't know whether Amazon was the largest hirer out of Stern, but a couple of years ago, 3 years ago, Amazon was one of the largest hirers out of Stern for MBAs. And I'll wager that their paycheck is mostly cash now, unlike 10, 20 years ago, where it would be mostly options. That tends to happen in companies. The total compensation is not changing, but less and less of it comes from equity. Any questions on equity compensation? And as I said, don't even play the adjusted earnings game. So when an analyst says, I've added back stock-based compensation, there are very few things I would say you should draw a line on. This is malpractice. There's no justification for doing it. I don't care what an analyst has been doing, and he's doing it for 30 years. It still just doesn't make sense. Yes?
the end of the day, it is a non-cash expense.
It's not a non-cash expense. Let's suppose I used options to pay all my suppliers. Let's say I used options to pay all of my cost of goods sold. Is my revenue my cash flow? Because if their logic then, if it's not actual cash, you're not going to treat it as a cash flow. It is an in-kind expense. Here's what I mean by it. You skipped a step. You took those options, you issued them to market. Can companies do that? They're called warrants. You'd have got cash, right? Let's say you took that cash and paid employees. Would it have been a cash expense? All I did was barter. If you let me use a barter system to evade cash flows, I'm going to use barters to make my revenues into free cash flow and ask you to give me a really high value for my company, and that makes zero sense. The best way to actually do this, to illustrate to somebody who's really stuck on this, is take 2 companies with exactly the same numbers, but with one add an extra $1 million in stock-based compensation. If they're using their measures of free cash flow, they both will have the same free cash flow. Ask them how much they would pay per share for the 2 companies. They say the same. Sell them the shares in the company with the option, because they clearly have no idea what they're doing because they're paying for something that's not there. So don't let that non-cash excuse come out. make it an issue of in-kind versus non-cash. Depreciation is a non-cash expense. Stock-based compensation is not a non-cash expense. It's an in-kind expense where you're giving away slice. In fact, the analogy I would use, and I might have used it here, is we own a pizzeria. Have you used this example? No? And I have 5 employees, and I pay them minimum wages because that's all I can afford to pay. And they're all threatening to leave because there's a restaurant down the street which will pay them $2 more. I cut a deal with them. At the end of every day, I give them 3 pizzas to take home, in addition to the pay. Non-cash expense, right? Or is it? I could have sold the 3 pizzas and made the money. I've given away the pizzas. I am less valuable as a company if I have to give out 15 full pizzas every day. That's exactly the way to think about employee options. You're giving away pieces of my business, and I've got to value it. I'm not saying you shouldn't use stock-based compensation, but I'm saying I'm going to make sure that I capture it in my value per share. So now let's talk about stories and numbers. We started the class with this debate about, which are you, where would you put yourself? Are you more naturally a storyteller, or are you more naturally a number cruncher? Okay? I'm going to ask you, I think, at that point in time for, kind of make that judgment for yourself. Let's have a show of hands again. How many of you are more naturally number crunchers? Okay. All the tech MBAs, except for Julian. Yeah. And there's nothing wrong with this. How many, and let me ask this question. Jessica, when did you know that number crunching was what you liked to do more? Not when you were in second grade or third. Remember, this starts very early, right? Because you have a math class followed by social studies. And you say, I hate that class, you have to learn the history of the colonial war. Who the hell cares? You're already starting your number crunching journey, right? In junior, my wife teaches 5th grade. If one of her 5th graders came and said, I don't want to come into the social studies class, she's going to say, you've got to sit in. It's not a choice. But as you get older, you get to make choices. You get to high school and you pick your AP classes. You're not picking AP history. If you're a number cruncher, you're picking AP math, AP chemistry. Then you get out of high school, then you go on to college. Now, of course, you've got that core curriculum crap in the middle here, where they make you take all the classes you don't really need. But then you get past that, you pick the classes through, you get a number crunching degree. It could be engineering, it could be actuarial science, it could be software, whatever it is. And then you go to work in a number crunching job. And who do you hang out with? Other number crunching people, right? And you share the same delusions. The delusion of precision. It's a delusion, but you add 3 extra decimal points. The delusion that you're being objective because you use numbers. And the delusion that you're in control. You know what I mean by the delusion if you're in control? You measure risk. You know why? Because you think by measuring risk, somehow you control risk. It's delusions because none of those are true. I want to pick on some of the storytellers, not Julian, because he did go to not a typical storytelling place. He went to work for Airbnb. So they do tell a lot of stories sometimes, right? And so what did you do at Airbnb, Julian? This is not a number crunching destination usually, right? It's usually, this is usually it's not a storytelling destination. Did your parents force you to do this or something? If you're Indian, I would have assumed that's what happened, right? Because in Indian, you're a storyteller. You go to your parents and say, I want to get a history major. They're going to slap you around the face saying, go become an engineer, right? So I'm assuming that did not happen to you. So somewhere you took a pathway and ended up in what would typically be called a number crunching job. Any typical storytelling job, people here? You're saying, what's a storytelling job? Dagmara? Marketing, very much storytelling. Strategy, a lot of storytelling. Journalism, storytelling run rampant. There are storytelling jobs. Different skill sets. And if you go into storytelling, you hang out with a lot of marketing people, right? You tell a lot of big stories around lunch. Nobody's putting any discipline in these stories. You talk about the 3 Ps or the 4 Ds or whatever it is in marketing. And essentially you hang out, and you have your own set of delusions. Like what? If you tell a big story, I should give you a high value. You also have a lot of anecdotal examples come up. Why should we do it? Because Coca-Cola did it in 2003. Let's face it. Harvard invented case studies as essentially anecdotal evidence for you to do whatever you wanted. Some companies, point in time, did this and it worked, therefore you should do it. If you think about case studies, statistically, it's an awful way to learn business because using one example set in time to do this. So I think, and that divide is getting worse and worse. 40 years ago, you could have become an investment banker as a history major if you had the right connections and you could tell a good story. Today, the tribes are getting separate. In fact, in the investing business, you talk to a bunch of VCs, you know what you're going to hear? Lots of stories. VCs are terrible with numbers. You move and talk about the same company to 8 bankers, EBITDA multiples over and over again. And I think that we're losing a connection to valuation because of that. So good valuation is a bridge between stories and numbers. So what I'd like to do is take you through the process by which I try to do valuation and I follow this process because if I don't follow the process, I know exactly how this will end. I'm going to start trying to value a company, very quickly open an Excel spreadsheet and go off to the races. So I've got to slow the process down to let my weak side play out. So when I look at a company, and don't care what the company is, my first step is to tell a story about the company. What does that require? It requires me to understand what the company does. If I don't know what the company does, there's no way I can value the company. What does it make? Who buys it? Why do they like it? What does the market look like? What does the competition look like? Some of this is data, right? And a lot of it is just talking to people if you've never used a company's product. I remember when Beyond Meat filed for its public offering, the first thing I did was drive to the grocery store and buy 2 packs of Beyond Meat. Why? What's Beyond Meat's claim to fame? This pea-based protein that tastes, what's your first reaction? There's a pea-based protein that tastes exactly like steak. You're right. Your answer is right. And that was my reaction. I said, but there must be something there. So I drove to the grocery store, bought 2 packs, I brought it home. I think one was this Beyond Meat ground meat version, and another was a Beyond Meat, whatever, chicken chunks. And they did taste a lot like meat. So I said, okay. Then I keep reading the IPO and they talk about this potentially huge market. I'm saying, where? I mean, the market I think of is guilt-ridden meat eaters in the US or Europe who love meat but feel that the world is going to hell in a handbasket and they need to do something. But you know what they were talking about as a huge market? They were talking about all these vegetarians in the world who will now be able to eat things that taste exactly like meat. My reaction was, this story has a hole in it the size of the Titanic. I grew up in a part of India where I was surrounded by vegetarians who had never eaten meat. If you gave them something that tastes exactly like meat, they are going to freak out. They're going to say, what disgusting thing have you put in front of me? And this is why we need to test stories. Because there's probably some guy sitting in the Beyond Meat office saying, there are 300 million vegetarian Indians. Oh, what a big market out there waiting for us. It's not waiting for you now or ever, because you've never ever encountered what these people eat. And this is not something that's not in the top 1,000. They could be dying of hunger in a desert island, and you can go to them with Beyond Meat, and they say, I'd rather die. First step in valuation is understanding what a company does. So I'm going to take a company as my lab experiment to illustrate this. It was June of 2014, and I was reading the Wall Street Journal, the physical version. I no longer do it. I have a digital version, but the physical version. And I see a news story about a company called Uber. And I'll make a confession. June of 2014, I'd never heard of Uber. You say, what, did you live underground? Technically, yes. Because I lived most of the time in New York and I always took the subway. I never took car service. I shouldn't say I'd never heard of Uber. I'd seen the word Uber on my credit card statements in the months leading into June of 2014. Turned out that my second son was going to college in North Carolina, was using Uber and using my credit card. So I don't know how that happened, but I thought he was taking German language classes. The no umlaut on the U should have kind of given it away. So I read the story that says that Uber had raised $3 billion from venture capitalists who had priced the company at 17 billion. I'm using the words deliberately, priced the company at 17 billion. I was surprised. A German language class worth 17 billion? So I decide to, guess who I call first? I call my son. But it was 11:30 in the morning and he was still sleeping. He kept college student hours. You know what those are? It has nothing to do with the sun coming up and the sun going down. It's some celestial variation of that. They have no time zone. So basically, there's no such thing as being in the wrong time zone. My younger son still does this. He comes to California and he sleeps in from New York. Right? He sleeps until 2 o'clock in the afternoon. No. But 11:30 in the morning, he wasn't picking up his phone. Must have been on silent mode. So I called my niece who lived and worked in Chicago. And she was technically awake because she had a job and she was sitting at her desk, but she was in an awful mood. She picks up the phone. She says, "What do you want?" This is how she greets a favorite uncle. I said, "Have you heard of this company called Uber?" She said, "It's a ride-sharing company." I said, "What the heck is a ride-sharing company?" She said, "I don't have the time to tell you. Why don't you download the app and find out for yourself?" Hangs up the phone. Had manners, right? But I'm sitting up in my office in the 9th floor. I download the app. I hit the app. And then magical things start to happen on my phone. The GPS opens up and I see a car trying to drive towards 44 West 4th Street. Why try? In New York City, you don't get from point A to point B. You try. Go in the general direction, you zig and you zag. So I can see the car zigging and zagging, and I can see the name of the driver, George. I'm fascinated. Never happened to me with a yellow cab. 15 minutes later, the guy pulls up in front. At that time, we didn't have all these fencing in front, so I just ran out there and said, "Hi, George." He said, "You didn't enter a destination. Where do you want to go?" I said, "Nowhere in particular. But you drive me around for about 30 minutes. I have some questions to ask you." He thought for a brief moment I was a serial killer. But he must have decided I can take this guy. He said, "Get in the back, ask me the question." So I said, "Is this an Uber car you're driving?" He said, "No, this is my car." I said, "Why are you doing this?" He said, "I have a job. I don't get paid much. This allows me to earn a second income." The car. I said, "Why do you need Uber?" He said, "In New York City, it's illegal to stop on the streets and offer somebody a ride." And that's actually technically true. You can't be a gypsy cab and just stop on the street. He said, "Uber connects me with customers." So I kind of got why this guy was doing what he was doing. Took a car he already owned. I did ask him, "Did you tell your insurance company you're doing this on the side?" He said, "What they don't know can't hurt them." I said, "Okay." Right? So he drops me off 30 minutes later. I offered to pay him. He said, "You don't have to pay me." I said, "It's free." He said, "It's not free." He said, "Did you enter a credit card when you downloaded the app?" I said, "Yes." He said, "They will charge you." I said, "How do you get paid?" Shows you how completely unaware I was of this business. He said, they send me 80% of the fare. I said, "Why 80%? Why not 85, 75? He said, "I don't know. That's what they all do." And he drives off. So at this point, I knew why Uber did what they did for connecting cars to customers, neither of which they owned. They got a 20% share. Nice business to be in. Which left me with actually two final questions. The first was, why do people like my son and my niece like Uber? To give you some perspective, this particular son of mine is incapable of hailing a yellow cab. I can't even imagine him doing that. Now, because how do you hail a yellow cab in New York City? What do you have to do? You've got to go out in the street, put your hand up there, wave, and the cab has this for hire, not for hire, it kind of flips and not flips. Maybe you'll stop, maybe you won't. It's probably the same technology that was used in the late 1800s to hail a horse carriage. This kid of mine is incapable of doing this. So I was curious, why would he take a car? So I said, I called him this time and he had no excuse for sleeping. 3:30 in the afternoon, so a basketball game was on and I knew he'd be awake. I said, I noticed you've been using my credit card to back up your ride sharing. I acted like I knew what it was right from the beginning. And he said, why would you want to do that? You took a car down with you to North Carolina when you went for college. Why would you need to use Uber? He said, Dad, on Friday nights and Saturday nights, I really like Uber. Now, as a parent, there are some follow-up questions you don't ask. What exactly is special about Friday nights and Saturday nights? But I kind of got it. I said, what do you like about Uber? He said, I can call the car from the bar. I say, okay. But you must wait forever, right? He said, no, they come sooner than a cab. I said, it must cost a lot, right? He said, they're cheaper than a cab. The cars must be filthy, right? They're cleaner than a cab. I said, let me get this straight. They come sooner than a cab. They're cheaper than a cab. They're cleaner than a cab. Cab service is destined for doom for lots of different reasons. So now I could see why ride-sharing companies would take off. This is very early in the game. And then there was one final question. What's so special about Uber? It's an intermediary. Why couldn't I get a really powerful computer, install it in my basement, connect cars to customers, take 20%? And there are two things that Uber had that I did not. One was $3 billion. They did, I didn't, so it's a bit of a problem. The second is, this is a business with what I call networking benefits. What does that mean? If you're a ride-sharing company, as you grow, it actually gets easier to grow. Why? Because if you're a driver, you want to go where everybody else is. So it's almost, it's essentially a business where as you succeed, you're basically going to push out the competition. The end game in this business is you're going to get one, maybe two players in any particular area because it's a business where that's what you're going to end up in. That was my research on Uber. You say, why don't you look at their financials? What financials? The company was privately owned, extraordinarily secretive, and the only two numbers I knew about Uber was how much they collected as gross cab fare, the total fare, the previous year, which they'd leaked to one venture capitalist, and how much money they lost in the previous year, which they'd leaked to a different venture capitalist. Two numbers. But let's face it, even if I had access to all of the financials for Uber, what would I have learned? They don't make much in revenues. They lose a lot of money. I knew that already. So one of the things recognized with young companies is the absence of financials might seem like a huge issue, but it's not going to help you if I gave you every financial of the company because there's not much there. So I actually drew a picture. And I try to do this every time when I sit down to value company to understand what drives the company I drive. So it basically is a picture of what I just described. How does Uber make money? Why do customers like Uber? Why do drivers drive for Uber? What makes Uber different from competitors in the business? Okay. So that was my starting point, my research, understanding the business. Second stop, I want to tell a story about the company. And I want to remind you, you're not a creative novelist. You're telling a business story. I have two pieces of advice. First, keep it simple. I'll tell you the type of story you should not tell as a business story. But 15 years ago, my oldest son came to me with a reading suggestion. He said, Dad, you got to read this amazing book. This book is 1,200 pages thick. I turned the book and look at the title. It says Game of Thrones, George R.R. There are two R's in the middle. That kind of puzzled me. Why are there two R's in the middle? I tried. I take my kids' suggestions very seriously. Halfway through the book, I called him and said, Ryan, I'm too old for this. There are like hundreds of characters in this book. They wander on, they wander off, they die, they come back to life. They're bad guys, they're good guys. I kind of give up on this. I prefer to stick with the Disney version. There's a good guy, there's a bad guy, nothing in the middle. If you're telling a business story, don't make it Game of Thrones. You don't have 8 seasons and 80 episodes to tell your story. You have like 15 minutes. Keep it simple and keep it focused. What's the end game for any business? You got to show me a pathway to make money. I know you can't make money now, but tell me at least you've thought about that possibility. Because we haven't thought about it, it's not magically going to show up on its own. You know how many people or founders or wanna be founders I listen to their stories, and they're usually tech people who are very fascinated with their own technology. They spend about 25 minutes telling you how amazing their product is, how great their platform is, how many people use the platform. And then I stop and say, that's all great, but how do you plan to make money? They say, what? I'm supposed to make money? Yeah. Having millions of people visit your platform does absolutely nothing for me. The reaction is, I'll think about it later. When? You're designing a business, you got to think about it right from the beginning. Is it a subscription-based business? You're going to build your platform very differently than if it's a transaction-based business or an advertising-based business. Keep it simple, keep it focused. So I'm going to take my own advice and tell you my Uber story in June of 2014. The reason I keep emphasizing that date is I've valued Uber pretty much every year since 2014. Do you think my story has changed? The core story might be a car service, but if you look at the car service business, think of all the things, regulatory, legal. The California Supreme Court of 2016 said drivers are employees. You can't do this independent contractor crap. Think of all the things that happen. Each of those things, in a sense, alter your story and your value. So I'll show you a later valuation of Uber, but this is the June 2014 version. And in June of 2014, here was my story for Uber. I described them as an urban car service business. Every word here is going to have consequences. So when I describe Uber as an urban car service business, I'm describing them as succeeding in cities and big towns as a car service business. Second, which will bring in new users into this business. People like my son who would not have been part of the car service business are going to come in because they feel more comfortable with the technology. Third, I did assume that this is a business with local networking benefits. You think, what does that mean? I talked about networking benefits where if Uber becomes the largest ride-sharing company in New York City, there'll be a tipping point where effectively they dominate the city. You're saying, what's a local doing there? In my story, Uber can take New York, Lyft can take Chicago, Didi can take Beijing, Grab can take Kuala Lumpur, and Ola can take Mumbai. What does that mean? The total car service market around the world is not going to have 2 or 3 players, it's going to have 8 or 10 or 15 players. The market share that I get. And finally, in 2014, I did assume they could keep doing what they were doing. Remember that 20% was absolutely arbitrary. I'm convinced that Travis Kalanick had dinner the previous night, had tipped 20% on his dinner, and he was thinking about, hey, what should I take of this slice? He said, 20% sounds good. And finally, I did assume they could continue to not own the cars and not hire the drivers. That's a story I'm going to build on. But before I build on that story, I've got to stop and make sure that I haven't fooled myself. Remember, in valuation, the person you got to worry about fooling the most is yourself. You can delude yourself if you really, really like a company. So I pass it through what I call the 3P test. Is it possible? Is it plausible? Is it probable? Sounds like I'm playing on what? Each one I'm upping the ante. Possible means it can be done. It's a very low threshold. Plausible means somebody somewhere has done something like this, maybe in a different business. Probable means you can show me some evidence that you've tried this out in a part of the world and your story is actually held up. I've struggled with ways of explaining the difference between the three. And a few years ago, I was in Latin America, about 10 years ago, right after I wrote the narrative and numbers book, and I was giving this session in 3 Latin American cities. First day, I was in Sao Paulo, Brazil. Second day in Santiago, Chile. And third day in Lima, Peru. And I'm doing the session on possible, plausible, probable. First day, I land up before 300 Brazilians in Sao Paulo and say, I want to pick a topic where every person in this room is going to have an opinion. So help me out here. What's the topic I would pick? Soccer. 6 months before that 2018 World Cup, and ask the question, is it possible that Brazil will win the World Cup? You ask 300 Brazilians 6 months before a World Cup, is it possible Brazil win the World Cup? What's the answer you get? Of course. Then I said, is it plausible that Brazil will win the World Cup? If I'd asked this question in November or December of 2014, the room would have been shaky. I won't ask you why, because it's a painful wound you want to cover over. But there was a World Cup in 2014 that happened to be in Brazil, where Brazil got to the semifinals. Here's where the good story ends. They played Germany in one of the great shellackings of all time. So luckily, this was 3 years later. The amnesia had developed. They forgot all about 2014. They were second ranked in the world. They said, yeah, it's plausible. Then I said, is it probable that Brazil will win the World Cup? And now you can see the wheels start to go into motion. We're in the right group, and Neymar stays healthy, and this happens, and this happens. It worked so well in Brazil. I decided to take to Santiago, Chile, and I did not do my homework. So I get in front of 100 Chileans, and I say, is it possible that Chile will win the World Cup? Grown men in the audience start weeping uncontrollably. You know what had happened? The week before, Chile had lost to Argentina, had been knocked out of World Cup contention. I think one of the things you need to do to win a World Cup is actually be there. Is it possible? No. The rest becomes, I feel pretty much in the same place as a Yankee fan today. Any fellow Yankee fans here? It's been a tough week. A week ago, if you asked me, could the Yankees win? 4 weeks ago, if you asked me, could they win? Possible, plausible, even probable. We're just 2 pieces away. It feels like a distant past now. Because in the last 4 weeks, we've lost Giancarlo Stanton, and 2 days ago, we lost Jared Cole. So you have no idea who I'm talking about. Those 2 big pieces, possible, plausible, probable, already you can see. I can do possible. Why? Because every team is at 0 wins and 0 losses right now. But the plausible has become tougher, and probable has become much slower. That's the kind of, so I have an assignment for you. After class today, sometime this evening, I want you to find an old Shark Tank episode, right? Now it's all recorded. You can watch it. You can stop it. So you know the standard format, right? A founder gets up and describes the business they're starting. I want you to think about 3 questions you would ask that founder before the sharks jump in. And the questions have to try to eke out, is this business possible? Is it plausible? Is it probable, right? I've heard founders on that describe business as completely impossible. But if you pass the possible, you're saying, can we pull it off? I'm looking for evidence. Did you try this in a city? Who bought it? So if you're a yoga instructor, you've done really well, and you talk about starting 500 yoga centers, well, the question is, how do you replicate yourself if you are centered? So I'm trying to figure out how much of you has made this center successful. Possible, plausible, probable. Because we are surrounded by stories that are impossible, implausible, and improbable. Let me give an example of an impossible story. You know what a fairness opinion is? What is a fairness opinion? It's basically a fig leaf that an acquiring company gets to protect themselves, give them legal protection against getting sued when they overpay on an acquisition, which is more common than actually paying a decent price. The Delaware courts in 1986 created this rule that if you do an acquisition and you get a fairness opinion, even if you overpay, it could be the worst deal in the world, that your shareholders couldn't sue you because a banker signed off saying this value is fair. Which raises an interesting question. Has there ever been a deal that has not gone through because you could not get a fairness opinion? The answer is absolutely not. What does it tell you? Fairness opinions are where valuation first principles go to die. Because bankers essentially have to defend the indefensible, come up with numbers. So they break every single rule in valuation. This is about 10 years ago, one of the most hopelessly conflicted deals of all time, when Tesla acquired SolarCity. To see why it was hopelessly conflicted, who was the largest shareholder in Tesla at the time of the deal? A guy called Elon Musk. Who was the largest shareholder in SolarCity at the time of the deal? A guy called Elon Musk. What a coincidence. Same guy, right? Who was the CEO of Tesla? A guy called Elon Musk. Who was the CEO of SolarCity? A guy called Musk with a different first name, his cousin. They merged, and they knew they were going to get sued, so they wanted to get protection. So SolarCity hires Lazard. Lazard is an old-time New York investment bank to give a fairness opinion. Tesla hires Evercore. It's a boutique investment bank. You're saying, what's a boutique investment bank? It's like a gastropub. You know what a gastropub is? You walk by them in the airport, never go in. A gastropub is just a burger joint where they triple the price. They call it gastropub, right? They're kind of fancy name. So boutique investment bank just does what investment banks do, but they charge you 3 times the price. So both sides go to play. Lazard does the typical banking things to justify it. What are the typical banking things? Apply a terminal multiple, do a little dance, but none of it was, uncommon. So I said, you're doing the typical banking thing. But then I looked at the Evercore valuation of Tesla, because it was an exchange offer. They had to value both companies. So Evercore actually had to value Tesla. And it is, in my view, the worst discounted cash flow valuation I've ever seen in my life. You know how tough that is as a contest to win? So here's what they did. They took Tesla and they projected out 5 years of cash flows. They did the kabuki of capex, depreciation, working capital, FCFF. They might not even have the F, FCF. At the end of 5 years, they get tired. So what do? They estimate a terminal value. I guess they didn't feel the need to use multiples. They decided to use a growth rate in perpetuity, saying this is good. They made the right choice. The only problem is they used a 6% growth rate forever. My first reaction is, what currency are you valuing the company? Maybe Argentine pesos, and you forgot to tell me? A 6% growth rate forever at a time when the economy was growing 3% a year. Work out the math, right? Sooner or later, what's going to happen? Tesla is going to become the US economy. Okay, globalization, keep going. 20 years later, it'll be the global economy. Then what? Now SpaceX has to enter the story, and Mars has to get populated, because there's no way out of the story. This was nonsensical. And for this piece of crap, you know how much Evercore got paid? $8.5 million. There's no justice in this world, right? I gave the stock at Evercore, and actually in the elevator, I was with the 3 bankers who did the deal, and I told them, I don't know how you guys ever put your names. You will live in infamy for what you've done. I will make sure you live in infamy, because I've saved the document. I've written about it in real time. So that post I'll send you, because I also sent 7 questions to the Delaware court judges as suggestions that they should ask bankers on the next time a fairness opinion came in. Impossible valuation. I've seen people make assumptions about growth, and you can grow, obviously. But one of my favorites was about 10 years ago, somebody valued Netflix. Netflix is always one of the most widely picked stocks in this class to value. Valued Netflix, middle of the semester, like you, I give them a one-time chance to get feedback. I look at the Netflix valuation, and he's got a value 4 times stock price. I'm surprised. There's a company that's really tough to get close to fairly valued, 4 times the price. So I take a look at his assumptions. And he has revenues of $600 billion in year 10. So I emailed the guy and I said, can you come into my office? I have some questions to ask you. So he comes in and said, what's your question? I said, I noticed you have $600 billion in revenues in year 10. I said, do you have Netflix? He said, yes. He said, how much do you pay per year? He said, about $100 a year. I said, you got 600 billion revenue, roughly $100. How many subscribers would Netflix need to have? He pulled out his calculator. They say you don't need a calculator. 600 billion, 100, that's 6 billion people. He said, I don't see where this questioning is going. I said, just hang in there. I have a couple more questions and then you can leave. I said, how many people are there on the face of the earth? He said, I don't know. I'll check out Google. I said, I'll save you the trouble. It's about 8 billion. Is there something you haven't told me? Maybe there's been a law that's been passed that every man, woman, child, and pet has to have their own Netflix account and they can't share. He said, don't be absurd. I said, I'm not the one estimating 600 billion in revenues. You are. And I said, how do you come up with this number? He said, I just took last year's number and I projected it out. He said, what are you talking about? He said, last year they had 30% growth. I just put it in for the next 10 years. You created a fairy tale. Right? Third, can you cut costs and improve margins? Absolutely. And if you're an inefficient company, I can give you growth next year. You do it in year 2. I'm saying, okay, year 3, but you keep doing it forever. We have a problem. You see why? You keep cutting costs. Your margins keep going up. Your margins hit 100%. Your costs have gone to 0. There's nothing left to cut. This is why you can't use cost cutting as a rationale for terminal growth in perpetuity. And finally, there's a very technical version of an impossible valuation. Many banking valuations will have a depreciation line item and a CapEx line item as separate line items. And the two will grow at different rates. And if you're not careful, depreciation will hit CapEx and keep growing above the CapEx. And in a sense, forever, because you put into your terminal cash flow. Can't happen. Because if you don't CapEx it, there's no depreciation. Those are impossible valuations. Let's talk about implausible valuations. Implausible valuations can happen, but you better have a really good story. So the first one, you have a company that's growing without much in reinvestment. How can that be? I'll give you a good story. I'm an infrastructure company. I've spent the last 20 years building the infrastructure. I've just opened it up for use. I'm going to get growth, but I don't need reinvestment. I'm a pharmaceutical company. I can get growth without, because my reinvestment is 7, 8, 9 years ago. I'm looking for that story to justify it. So if you give me Novo Nordisk, a valuation of Novo Nordisk, where you give in 20% growth for the next 5 years with very little R&D, I can see where that's coming from. That Wegovy and Ozempic is continuing to feed into your growth rate. Or you have a company which makes high margins, much higher than everybody else, but there seems to be no competition coming in. If it's a pharma company, the explanation is simple, right? There's patents. But what if it's not a pharma company? You got to tell me a story as to what keeps the competition out. I remember valuing a company called Almarai. It's a Saudi food processing company. Its margins were twice as high as everybody else in the Middle East in terms of food processing. And I was puzzled. How come no competition? So I actually presented this in Dubai. There were a few people from Saudi Arabia there who were familiar with the company. And one of them said, you should check out who the biggest shareholders in the company are. And I did. Second on the list was somebody bin Saud, part of the Saudi route. There's your competitive advantage. You're looking for a good story to explain this. Or you have a company that makes high returns without much risk. Maybe it's politically connected. You got a government contract, the government is overpaying you, but because of your connections, you can continue to collect it. I'm looking for a good story. And finally, I have improbable valuations. To understand improbable valuations, I'm going to present one of my favorite devices for deconstructing DCFs. It's what I'm going to use. I'm going to give away the game. When you send me your valuations on April 4th, this is what I'm going to use to kind of look at your valuations. So Ria, let's suppose you send me your valuation on April 4th. I'm going to assume you will. Let's start at the top line. You got revenue growth, right? You can have high revenue growth, average or low revenue growth. Pick any one. Low, okay? So you have low revenue growth. It's your story. I'm not going to push back, see. But then I'm going to go check your cash flows. There's earnings and cash flows. The difference is what you're reinvesting, right? So if I saw low revenue growth, what should I expect to see in reinvestment? Low reinvestment. I should expect to see low reinvestment. Then I check your cost of capital. Generally speaking, companies with low revenue growth and low reinvestment should have lower than average cost of capital because you're probably in a boring business with low growth. Low, low, low. In contrast, when Leon turns in his valuation, there's going to be high revenue growth. I don't know how high, because Reddit, potentially everything is in the future. But then when I look at reinvestment, I want to see what they're reinvesting to get that revenue growth. And I would expect their cost of capital to be higher than the typical company because they're still in that growth phase and they're an online advertising company. High, high, high. I'm okay. About 80% of your valuations will be either high, 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 low, 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 average, average, average. But about 20% of your valuation, one of those sides, or maybe two, will be out of sync. You know what I mean by out of sync? High revenue growth, low margin, low reinvestment. And then I'm going to look for your story. So if you're doing Boeing and you put in high growth, low reinvestment, and low risk, somebody fill out the story that'll explain that combination. Where's the high growth coming from? The fact that their revenues last year dropped to half the aircraft they had 5 years ago, that maybe Airbus will screw up on something really big, and then you'll come back. So the revenue growth is a number of it. Why don't they need big reinvestment to do this? Because they have huge excess capacity on their plants. And why is it low risk? Because you're only two players in this game. High growth, low reinvestment. So I'm not saying that's a story, but you can see that there's a story behind that. So as you look at these companies, that's what you're looking for. So I told you my Uber story. I passed it through my own test. Is it possible? Yeah, definitely it's a car service company. Is it plausible? I can justify it. Remember that story about attracting new users? In 2014, Uber had been in the Bay Area for 5 years already, and they doubled the size of the car service business in the Bay Area. In what sense? Because people are not buying cars anymore. Uber or Lyft was so ubiquitous that they just stopped. My story is possible, plausible, probable. Could I have told a bigger story? Yeah. So next session, we'll talk about what happens when you make your story bigger, how the onus is now on you to come up with the defense that justifies it. So I will see you on Monday.